Good afternoon, and thank you for joining the Midway first half 2023 results webcast. I'm Tony McKenna, CEO and Managing Director of Midway, and I'm here with Michael McKenzie, the Group CFO. I'll give you a brief rundown of the key points from the investor pack that was lodged with the ASX earlier today, and then Michael and I will be very happy to answer any questions via the chat box. So if we switch over to the presentation now. The results show the early stages of Midway turnaround. The good top-line numbers, with revenue up 18%, are based on positive contributions from all business units, with the exception of Tasmania. It's also very pleasing to achieve a break-even EBITDA result in an environment of rising supply costs and lower bone dry component. The successful sale of the Victorian plantation estate to MEAG was a highlight of the first half. The $12.3 million book profit on the sale of the plantation estate drove the positive NPAT outcome. It has also enabled Midway to repay $21.7 million, eliminating all long-term debt. Net tangible assets has also further strengthened to $1.51 per share. Despite these positive numbers, operating cash flow remained negative in the first half 23 due to high operating costs, including fuel, labour and wood supply, and a net working capital build from June 22 of $8.3 million. The board has adopted a prudent approach to capital management and deferred consideration of the intended fully franked special dividend of 19.5 cents per share at this time. The board will revisit its decision on dividends at the end of FY23. It remains the company's intention to pay shareholders the special dividend. The board believes that ensuring availability of working capital is one of the levers that is in its control. In the current global economic circumstances, the timing of vessels can change with big impacts on the company's working capital requirements. Inventory may need to be held longer to deliver into increased orders. Having been through periods of limited demand and then supply production limitations, it is essential that production and sales aren't constrained by working capital limitations as we move into more favourable conditions. Now to the key drivers of the result. The major contributions to growth came from improved volume and price across the business and a better FX position. Customer demand was stronger than the previous corresponding period, and Midway is confident of significantly improving pricing for the calendar year 23. I'm particularly pleased that the Tiwis, Southwest Fibre, Queensland and Geelong all recorded positive business unit EBITDA contributions. Midway Tasmania had a challenging first half, with significant wet weather hampering harvest and haul operations and managing the commissioning of the new mill at Bell Bay. In December, we used the last of the out-of-the-money FX hedges at 75 cents and now move into a more favourable FX hedging position. Unfortunately, some external headwinds continue to drag on EBITDA. Supply costs increased significantly in the half. Midway was required to pay suppliers higher wood fibre prices, passing through part of the wood chip price uplift. And ongoing COVID supply chain disruption and the war in Ukraine increased labour and fuel costs. The other major external factor affecting Midway results was the wet weather caused by the prolonged La Nina weather event. Particularly in Tasmania, the wet weather resulted in interruptions to harvest operations and a lower bone dry factor. The first half. Other key drivers. The graphs in this slide show that headwinds that impacted operating margins in the first half 2023, a lower bone dry factor and higher costs from fuel and labour. The outlook on these supply costs are that fuel is expected to remain stable and labour costs are set to remain high in this inflationary environment. Management will of course continue to actively manage these factors to minimise the impact on EBITDA and cash flow. The Bureau of Meteorology has forecast that weather patterns will trend away from wetter La Nina conditions towards drier El Nino conditions over the course of calendar year 24. Drier El Nino weather conditions will contribute towards a higher bone dry component on the PCP. I'll now look at the trading outlook. The first half 23 results shows early signs of the turnaround in Midway's operating performance. The global wood fibre market is strong and we expect to see higher volumes and prices on a PCP basis in the second half 23. Midway has supply agreements for all of its expected hardwood fibre production for this calendar year. We expect negotiations will soon be finalised for the benchmark eucalyptus globulus price for calendar year 23 at around US $200 per bone dry metric tonne, a US $20 increase on the PCP. We have already seen a $25 increase in the eucalyptus nitens price and a US $23 price increase in the North American softwood benchmark price. The strong growth in demand from China saw growth in exports from Australia, but supply chain constraints caused Australia to lose market share. Customers continue to buy a range of wood fibre products from Midway for the China market, including regrowth thinnings from Tasmania. Japan also continues to provide steady demand for higher quality wood fibre from Geelong and Portland. The emergence of Indonesia as a net wood fibre importer is also important. Midway exported its first wood fibre cargo to Indonesia in early February and is contracted to do more vessels in this calendar year. Industry experts expect that the continued gap between regional supply and demand will underpin wood fibre export prices into the future. I'll now turn to the capital management and balance sheet. Since the strategic review started in March 2022, the company has been investigating ways to generate total shareholder returns that reflect the underlying value of its assets. A key outcome of that approach was the sale of the Victorian plantation estate to Midway. $97.3 million in upfront sales proceeds has allowed Midway to repay all of our long-term corporate debt and substantially pay down the expensive strategy financial liability. The elimination of net debt is particularly important in a rising interest rate environment. Less visible but nonetheless important is that the sale of the plantation asset will take biological assets off the balance sheet and remove annual P&L revaluation volatility. It remains the company's intention to pay the special dividend and the board will consider timing at the end of FY23. A stronger balance sheet. The sale of the Victorian plantation estate has also improved our balance sheet. Midway has a strong current ratio of over 2 times. Net tangible assets of $134 million or $1.51 per share compare with $124.8 million, $1.41 per share at the end of June 2022. Retaining cash within the business will ensure the company can ramp up production, build and sustain higher inventory levels, and fully exploit sales opportunities in stronger export markets. Now onto the company strategy. Over the last 12 months, I've focused on 3 priorities to generate total shareholder return reflective of the company's underlying asset value. Firstly, lifting operating performance. Secondly, leveraging our core capability for future growth. And thirdly, maximising the value of our assets. We are making good progress in each area. On operating performance, we've seen positive EBITDA contributions from all key business units with the exception of Tasmania and our plantation segment. We expect Midway Tasmania to turn around in the second half with much better weather conditions expected and the Bell Bay mill in full operation. The plantation business unit has been repositioned with the sale of the plantation estate to MEAG, and the second half will see it bed down its new management fee model. We've exited the loss-making Midway Logistics business. On leveraging for growth. At North Shore Geelong, we're establishing a softwood line and have progressed the grain terminal proposal. We've commenced wood fibre shipments from Bell Bay in Tasmania, progressed the second rotation on the Tiwis, and gained a foothold in the carbon management sector. In maximising the value of our assets, we've sold surplus assets and the Victorian plantation estate all above book value, and we're working on initiatives to add value to our Geelong site. After 12 months in the job, I'm very clear what needs to be done to create shareholder value, and I'm confident that we're making strong progress. There are 3 key areas where I see short and longer term growth opportunities for Midway. Firstly, we must continue to expand our core business, wood fibre production and export will remain the engine room of the company for the foreseeable future. Expansion of the Victorian plantation estate and its management, expansion into regrowth thinnings in Tasmania, and the new softwood opportunities underpin future growth. Secondly, the proposed grain terminal at North Shore leverages our existing asset base and commodity capabilities. The grain terminal will add value to our property asset and increase utilisation of our take-or-pay commitment with Geelong Port. We've made good progress with counterparties on project design and management and with the planning of the site. We're engaged with counterparties and Geelong Port on negotiating commercial terms. Thirdly, carbon management is a natural complement to the Midway value chain. We are very well placed to be leading generators of high-quality carbon emission offsets, creating ACCUs for global and domestic investors in the next 10 to 20 years. Midway's strategy is aligned with some fundamental growth trends. Firstly, the ongoing regional deficit in the supply and demand balance for wood fibre. China's demand has structurally increased with new virgin fibre mills in operation. More mills are under development. We are also seeing signs of biomass demand tightening the supply-demand balance for wood fibre. This places Midway in the box seat to leverage wood fibre supply and demand. Secondly, the global push for net zero emissions by 2050 will drive increased demand for carbon offsets. As I've said, Midway is ideally placed to be a large-scale generator of high-quality Australian carbon credit units. The Labor government's proposed legislation for the safeguard mechanism is expected to heighten demand for offsets. Midway has 3 scale projects underway to leverage its core capabilities and capitalise on this market. The Tasmanian Carbon Aggregation Project, the Victorian Plantation and Carbon Management, and the Tiwi second rotation are all progressing well. Midway is building a strong presence in the carbon offsets market and securing future revenue streams for the company. In summary, these results show that the Midway turnaround is gaining traction. Trading conditions are stronger and will drive improved financial performance. We have clear strategic priorities aligned with favourable macro trends, and we will continue to focus on maximising shareholder returns. We understand that some shareholders will be disappointed that we've not declared the intended fully franked special dividend at this time. However, I believe it's a prudent approach to capital management, and it will ensure that we are able to confidently build inventory to deliver into our supply agreements without being vulnerable to working capital constraints in the event of customer vessel delays. I'm confident that our revenue, operating cash position and earnings will improve in calendar year 23 on the back of higher export prices, volumes and a better FX position. Midway will also receive the next tranche of the MEAG sale proceeds in September this year and the final tranche of the sale proceeds around September 2025. I'll now turn to questions via the chat box. The Q&A box in the Zoom screen.
Thanks. We've got several questions. The first from Chris Honig. How will Midway qualify for ACCUs through its operations, such as the Tiwi Islands? How many ACCUs are anticipated? Can Midway distribute ACCUs to shareholders as dividends?
So there's 4 ways that you can earn plantation ACCUs across 4 different schedules. The 2 that we're focusing on is Schedule 2, which is a short rotation to long rotation, and Schedule 3, which is a retention of a plantation operation where it wouldn't otherwise occur. We are doing some Schedule 1, which is greenfields to plantation. So through those 3 methods, the government regulator calculates ACCUs that are accrued for a particular activity. We go through the process of registering and earn the ACCUs either for ourselves or for our clients or a combination of both. Can we distribute ACCUs to investors? That's something that we don't have the capability or desire to do. It would overly complicate things, but what we're working on is building revenue streams from managing the process of managing ACCUs, from earning a share of ACCUs ourselves, and for developing projects where ACCUs make the project economics work to support new plantations going in.
There's a follow-up question from Chris Honig. For MEAG, where will the new R1 estate be located, and what pricing is provided for timber under the strategy?
The new R1 estate, so not exactly sure. Sorry, I'm just reading it on the screen. Yeah, so for MEAG, we're looking in the Otways and Heytesbury regions. We have made an offer and settled our first acquisition, around $5 million invested in that. We have 2 other properties that we have MEAG approval to submit offers on, and a number of others in the pipeline. They're in the, as I said, in the Otways and Heytesbury region that'll naturally feed into the Geelong site.
Final question from Chris Honig. The 200 million investment, I think the question is where and when will that occur?
Yeah, so as I was saying, we've already settled on the first 5 million of that. Over the next 5 years, we'll be looking to invest that as opportunities present, but we have a good pipeline, and we're working through the process with offers out at the moment.
And the next question is from Campbell Morgan. Can you please detail how much hedging at 75 cents cost you in 1H23?
Absolutely. Michael?
I can take that one. So thanks for the question, Campbell. As we know, that was a long-standing position that was taken out nearly 2 years ago when the forecast FX was going up to 80 cents. Unfortunately, the average was 67 cents over the period, so it ended up costing us between $10 and $11 million to the bottom line at our current estimates.
Next question comes from Robert Thompson. What are you paying approximately per tonne at the farm gate for uncontracted supply?
So that varies across our different products, our different sites, mill gate prices, and mill gate prices are also confidential information because we've got a range of suppliers and a range of different arrangements. Question
from David Zhu. In our view, how much further can Vietnam increase their capacity?
That's a really good question. We don't have a definitive answer. There's competing land uses. Each year we think that they're reaching maximum production. Over the last year, we saw a big increase in what was harvested and exported because the prices were very strong. It remains to be seen how much of that. I was in Vietnam around the middle of last year and saw that they're cutting trees younger and younger, so that'll be eating into the maturity profile of the Vietnamese crop. But then all that area will have been replanted and will be coming back through.
There's several questions from Charlie Kingston and Anthony Back. I'll take Charlie's questions first. The first question is to you, Tony. Charlie says, you spoke a lot about realising shareholder value, yet the only way shareholders can access through the share price after today's sell-off is chronically below NTA and IPO price. How do you intend on fixing that? Are you still investigating the natural owner of Midway? Clearly the listed market is fed up.
Some fair points in that we're particularly aware of the gap between NTA and our market capitalisation, and it's something that we are constantly conscious of. Yes, we're always open to thinking about the natural ownership. It's part of the way I think about things inherently. to increase the share price, we have to get the earnings up. We have to be executing on the growth opportunities, and then we need to be thinking about the other initiatives which have included to date sale of assets that the market doesn't appear to be appreciating the value of, and obviously it's an ongoing exercise.
Second question from Charlie. Can you explain how Midway is leveraged to increase prices, given some shed with suppliers and other costs remain elevated, holding all else equal, including FX? Will Midway finally make an operating profit this year?
We believe so. Everything is lining up. As I said in the talking points, we do have better prices that we're very confident will be agreed and contracted. We have contracts for volume. The FX rate will be more favourable than what we've had last year, and there's a number of other factors that are working that say absolutely we should be profitable for the second half.
Charlie's got three quick questions. Can you explain the revenue model of MEAG? Do you get paid a percentage of funds under management, performance fees, etc.? Yeah,
so with MEAG, it's a fee per hectare. There's an establishment fee, which is a higher fee on establishing new plantations in the greenfield, and then there's the ongoing management fee that applies across the brown and greenfield sites. There is a small component of it which is leveraged to what we can do with carbon in the existing plantation, but primarily it's a fee for service across hectares.
Another question from Charlie. Can you elaborate on the delay of the Geelong grain terminal?
A little bit limited in what I can say, but we are talking to counterparties who are very credible, but we need to have a three-way agreement between ourselves, them and Geelong Port. Geelong Port have been a little bit delayed and distracted with their sales process, but we've had some constructive re-engagement just recently, and we're expecting some progress on planning as well in the coming weeks.
Last one from Charlie Kingston at the moment. Can you guarantee that you will pursue no further growth CapEx until you've paid a dividend?
Not my position to make any guarantees on dividends. It's a decision for the board. We don't, at this stage, envisage any major CapEx projects. There are some small CapEx projects in line with what we normally spend in a normal year. The softwood project will have a little bit. There may be some required upfront on the grain that we've flagged previously, depending exactly on how that is structured.
We've got three questions from Anthony Back. The first one covers the grain terminal discussions, which I think you've covered off in response to Charlie's question. The second one was how much revenue did Midway generate from carbon management in the first half? So
for the first half, it was limited to the fees that MEAG are paying, which had only just started flowing for the management of the estate that we're selling to them, I have sold to them, and we're building the business model in Tasmania and the Tiwi's still early stages in the revenue model.
Last question from Anthony at this stage. Can you outline what the 12 million in borrowing in the half was used for?
Yeah, I can take that question. So that 12 million is really part of our working capital funding. So as you can see, we had a working capital build of 8 million to December, which is included in the operating loss. So some of that is funded by our working capital facility, which was drawn down by 13 mil at December. So our net debt position, excluding AASB 16 liabilities, was 12 million cash surplus, which is positive. So some of that working capital was receivables. We had about 14 mil of receivables that was realised early in January. So at the end of January, we were actually in a net cash position of 24 million. So really it was used for working capital.
Just a follow-up question from Robert Thompson about the timber farmgate supply price. He's asking what has been the approximate percentage increase in farmgate supply price over the last 12 months?
So I can probably take that one. You know, in the last half versus the prior corresponding period, on average, some of our timber prices might have gone up $10 to $15 per GMT. That is made up of a number of components. Of, you know, 50% might be stumpage, which is linked to price. The remaining 50% is really fuel, CPI and labour increases. And that sort of hurt the margins for the half as we flagged. But going forward, as we're flagged, we expect some of the key drivers of the business to turn around. So that's what will improve the performance of the business.
Follow-up question from Campbell Morgan. Thanks for the previous response. So based on your reported results, your underlying EBITDA ex-hedging in the half was around 11 million. Is it reasonable to assume this is the basis for the second half prior to the implementation of the $20 per tonne woodchip price increase?
Thanks, Campbell. Don't want to preempt exactly what our results are going to be, but we're going to obviously, if we go through the key drivers of the business, volume, we expect to be slightly favourable. Price, we expect to be favourable. FX, we expect to be favourable as we're flagged. And bone dry, we also expect to be favourable. So as we're flagged, we expect a better second half. I'm not going to give exact guidance on what we expect, but all I can say is that the four key drivers of the business are looking favourable in the second half.
Question from Craig McGrath, which is probably another one for you, Michael. I believe your receivables increased significantly. Why? Is there any significant credit risk?
Thanks for the question, Craig. No, the short answer is no. So there's two things in the receivables. One is the MEAG deal. So we've got tranche 4 and 5 settling in September 23 and September 24. So a large portion of the receivables on the balance sheet are linked to a contract with MEAG just pending settlement of the final two tranches. And then we also have some trade receivables which increased, up to 14 or 15 mil on the balance sheet. That's low credit risk on the basis of the fact that all our vessels, particularly from China, are linked with LCs, so the credit risk is low and received in January 23.
Question from Emma Allsop about the grain terminal project. But this relates to the question is there a timeline for the project?
It's a fair question. I'm very keen to get it done as soon as possible, but it'll take the time that it takes to bring the multiple parties together to land on an agreed position.
Emma's also asked whether you can give some details about the expected scope of the grain project, for example, amount of grain stored.
Again, at this stage, that's confidential information that we're working with our partners.
Just scrolling down the list of remaining questions. Anthony Back has asked, what is the status of the second rotation in the Tiwi Islands?
Yeah, so we're working on the structuring of that. There's a couple of opportunities that have presented themselves that we're pursuing that could be very interesting for the company. It's we have initial engagement with the Tiwi people around the consultation for that second rotation. We've had the chairman of the Tiwi Land Council and the chairman of the Tiwi Plantation Corporation down in Geelong, and have spent some time with them last week. And one of our staff, one of the project staff is up there at the moment working with them on some consultation and around the structure that we pursue the project through.
Charlie Kingston's got a further follow-up question around dividends, and he's asking what your preference is to pay a dividend before any growth capex.
It would depend on the project. Absent a really compelling project, then it's certainly obvious that the right way to go is to pay shareholders dividends. But were there a really compelling project, and that's something that the board and management would have to consider.
Thanks. I'm just waiting to see whether we get any further questions. No further questions at this stage, so I think that completes the Q&A session. Tony, is there anything else you want to conclude on?
No, other than to thank you all for your attendance and attention. I understand it's a busy day in the market and appreciate your interest in the company, and hopefully look forward to your support going forward and to delivering you some results that really do create some shareholder value. Thank you.
Thank you very much.